Yo, check it out, I gotta speak the truth about the hardest working small channel in the crypto booth. He's the crypto father, the one and only.
Trading and investing in crypto is not like putting money into a bank. It's very different from the traditional trading, and there's a lot of new things that you need to remember in order to keep your money safe, to keep your funds safe. So in today's video, I'm going to talk about the 11 things that new investors to cryptocurrencies should keep in mind, the 11 mistakes to avoid in order to not lose all of your funds. Welcome back to the CryptoFather channel. Today is the 8th of January. Make sure to smash up the likes on this video because that helps. Subscribe to the channel and of course stick around till the very end so you don't miss any of the very important tips. If you're a new investor or a seasoned investor, for new investors, these tips will be essential. If you're a seasoned investor, these tips will be something that you should keep in mind anyway, so it's kind of a refresher for you. Either way, make sure to stick around till the very end, because you might just learn something. So I've made this in a PowerPoint presentation to make it easy, not too complicated. There are 11 things, 10 things, plus a bonus one that I'm going to talk about. It's something that you already probably know, but just in case you don't know, again, this is a brief refresher. Lack of basic crypto knowledge, very important. Ignoring fees, short-term thinking, keeping crypto in online wallets, forgetting crypto password or seed phrases, wrong wallet address, getting scammed, use of leverage, overcomplicated trading strategies, and order errors. And then one more bonus that I'm going to talk about. Lack of basic crypto knowledge. The new crypto investors may be attracted to all hype surrounding Bitcoin and other cryptocurrencies, but investing in crypto requires understanding the asset class and how it works. Investing in an asset you don't understand or trying to trade crypto without understanding how it works is a recipe for disaster. Educating yourself on a different crypto projects and the goals of each crypto company will make you a better investor. This basically means that particularly this was especially the case in the 2017 bull run when during the ICO craze, when everybody was throwing money left and right at new ICOs, new companies or projects that were coming up, and people were assuming that money would be made everywhere. It's very important that you take a look at the project and understand what the project is doing and why it's doing. Also, it's very important to know the difference between proof of stake and proof of work. I have a video on that on the channel, so scour the channel and have a look. Proof of stake projects run on a blockchain that is not requiring a lot of energy to produce the coins. They are minted in one heap and then they're distributed amongst the people who invest into them. Proof of work coins, however, require computational power in order to mine the new coins, and so that is basically where the value of these coins is produced. Best example is Bitcoin, the primary proof of work coin, and there are of course many others like Litecoin, Meowcoin, and so forth. But understanding the basics of cryptocurrencies and how investing works will set you up for success, or at least help you avoid complete failure. Because unlike with traditional banking, cryptocurrencies are in the hands of the user. There is no bank that you can go to and ask for help. There are exchanges, online exchanges, centralized exchanges, which may be able to help you. But in the case of decentralized exchanges, if you deal with those, there is no real help if something were to go wrong. So it's very important that you educate yourself about these things and that you take responsibility for what you're doing, because you can't run to anybody like you could in a traditional bank and request for help. And even then, occasionally you may be left to your own devices. So, but this particularly applies to crypto. So you have to make sure to understand the basics of how crypto works and understand that the responsibility is solely in your hands. The second biggest mistake that people do, especially when you're new, are the fees. There are a lot of fees, and I guess you could call them hidden fees. They're not really hidden, they're all visible, but if you're not aware of the fact that the fees exist, you may unnecessarily spend too much on fees. While there are many ways to buy crypto, new investors might jump into purchases without understanding how the blockchain fees, exchange fees, or other fees work. For example, buying crypto with a credit card may come with massive surcharges, like 3% or more depending on your credit card. There are transaction fees on the purchases of cryptocurrencies, and of course there are transaction fees on the trades. So if you trade between USDTs, any stable coin. And if you trade between the cryptocurrencies themselves, there are also transaction fees that you need to keep in mind and you need to be aware of. Depending on an average blockchain fees at the time you buy the cryptocurrency, you might end up paying hundreds of dollars in fees to different entities. Before purchasing, it's best to learn about the fees you might face and find the exchange at times when purchases are less costly. This could save you a lot of money in the long run. The best example would be Ethereum. Just in the past year, when the fees for Ethereum were exorbitantly high, it was almost bizarre. People were paying $50 for a small transaction of $10. And so you have to be aware of the fees. Make sure that you know these things before you start purchasing cryptocurrencies, because again, you could spend a lot more money in fees than is necessary. So that's something that you need to keep in mind. Brings us to the third thing that you should avoid doing, that is short-term thinking. A lot of the times people, especially new to the crypto industry or any investment really, but since we're talking about crypto, only look at the short-term gains, and people oftentimes hope to get in and get out and make millions within a short period of time. You have to understand that the crypto market runs on a 4-year cycle. For the most part, it has been, and it's based on the Bitcoin halvings. Bitcoin halvings take place every 4 years, and so we go through bear markets and bull markets. And in order to make massive gains or make successful gains, it's very important to look at the long-term investment. Unless, of course, you are a day trader, in which case you probably are not watching this video. Your strategy for investing and trading will be a lot different. But if you are like me and as you are a spot trader, then you should be looking at buying low and selling high, which kind of makes sense in order to make profits. But most importantly, do not panic sell. Understand the 4-year cycles and understand how markets move, the tops and the lows, and when to take profits and when to get out. The promise of get rich quick within the market has many new investors only thinking short term. That's what I was saying. And while there is a possibility of earning massive gains on a crypto investment, there is also a possibility of losing all of your funds to a bad investment move. Oftentimes people will get in, they will start seeing the market tank for whatever reason, because that's what markets do, and they will panic sell just to see things turn the other way and start pumping again. The average crypto investor loses most of their funds on crypto because they panic sell, because they don't look at the larger picture. They only focus on small intervals on the trading scale, and then see only the small moves. Keeping the idea of when in doubt, zoom out is a very good way of gauging the market, where it's going and how it's moving. Also, having a long-term investment mindset will help you choose your crypto investment more carefully. Concentrate on picking higher quality projects with long track records. Trying to get rich in 90 days is a fast way to lose everything, but thinking about crypto investing as a multi-year process will help you build a more thoughtful crypto portfolio. Understand that crypto is a long-term play. It's not going to change the world within the next 90 days. It hasn't done so in the past 12 years or to a questionable extent. So do not think of crypto as a get-rich-quick scheme. Number 4, keeping crypto online in online wallets. So whenever you start trading crypto, and the first way to purchase crypto is through centralized exchanges or decentralized exchanges. And all of these offer you custodial wallets. So whenever you purchase cryptocurrencies on an exchange, be it Binance, Bybit, or KuCoin, or whatever other ones, you're able to store your crypto on the exchanges. And while for the most part they're safe enough, you always run a risk of there being a hack or whatever problem may occur with online exchanges. Also, there are online wallets which you can use, and again, the same idea persists. You could run into problems with online wallets. They could be hacked. They could leak information to third parties or whatever the case may be. So it's often a good idea to store your crypto after purchasing it on hardware wallets. And once again, it's very important to keep in mind that there is no bank, there is no central authority. Even central exchanges do not really allow the same level of security or comfort in that sense as traditional banks do. You can't really walk into a centralized exchange and ask for help. If something goes wrong, oftentimes the service departments take forever to answer. And in many cases, once you send your crypto, it's irretrievable, which means once the transaction is complete, it's oftentimes impossible to retrieve that transaction from the blockchain, and so your funds will be lost. So you gotta keep that in mind as well. The most secure way to store your crypto is in an offline hardware wallet, which is essentially a USB stick with advanced hardware and software encryption to protect your crypto's private keys. The wallet that I promote here on the channel is the Descent wallet. It's a biometric wallet. It's about this size, smaller than your palm, and it looks similar to a Trezor, with the exception that it is a biometric wallet, and it stores the exact same amount of cryptocurrencies as every other crypto wallet. They continue adding it. They've got over 3,000 cryptocurrencies that are available on the wallet, and they continue adding more and more. So this is the wallet that I recommend for storing cryptocurrencies offline of the exchanges. The number 5 thing that you need to keep in mind is storing your passwords or seed phrase. So most cryptocurrencies wallets come with seed phrases and passwords. Tangem is one of the wallets that does not require a seed phrase. It does require a password, so you can check that out. I also have a video for that and a ref link below the video for both the Tangem and the Descent wallet. They're both below the video. When you do have a wallet, you need to store your seed phrases and your password in a secure way. One way I recommend to do is to save it on a written document somewhere in a hardware form and have it stored somewhere safe, so you always have access to it. Because once you lose your passkeys or once you lose your seed phrases, you're not going to be able to retrieve the funds from your wallet. You're not going to be able to access your wallet, and that's a problem. Millions of bitcoins have been lost, billions of dollars have been lost simply due to the fact that people forget their keys, forget their passphrases, and they're unable to access their wallets. And again, there is no centralized authority that will help you with retrieving the passwords, even in case of a company that produces the Descent wallet. Like when you have a Descent wallet and you forget the passkeys, the company, the manufacturer of this wallet, will not be able to retrieve the passkeys for you because they don't store any of that information. All of that information is inaccessible, and that's part of the security, that nobody other than yourself has access to the wallet, has access to the funds. So you are in charge of securing your access to the cryptocurrencies, to the access to the wallet, and you are in charge of managing your passwords and your passkeys. So it's very important that you keep that in mind and you keep those safe. Number 6 mistake to avoid is sending funds to the wrong address. Transferring crypto between digital wallets is how you take custody of your crypto from an exchange or send funds from one party to another. But a common mistake new investors make is attempting to transfer crypto funds to a wallet only to mistype the wallet address. Every single time before you send your crypto to another wallet or from the exchange to a wallet, to your wallet, you have to make sure that the passkey, or that the wallet address rather, is exactly as it should be. Wallet addresses are strings of letters and digits and occasionally some signs, and you have to make sure to check them. One simple way of making sure that the wallet address is correct is by copying and pasting it rather than typing it up. Typing up wallet addresses can lead to problems because there may be a difference in the capitalization of the letters and the order of numbers, and since the string of these wallet addresses is quite long, I think there is like 50 digits sometimes, and you might make a mistake in typing it up. So the best way to transfer is by copying and pasting these things directly, and you should familiarize yourself with the methods of copying and pasting the addresses accurately so you don't send it to the wrong address. And even after copying and pasting, you should make sure that the address does match the actual address. The address that you copy does match the actual address that you paste into the sending address, because once it's sent to the wrong address, once again, the crypto is in most cases unrecoverable. And if you send it from an exchange, in many cases, I think most cases, that's out of their hand. Once the crypto is on the blockchain, it's gone and it's sent to the address where it goes, and that's that. And the number 7 biggest thing is scams. There are so many scams in crypto. You have to be very, very careful. That's another step that you need to make sure. There are phishing scams that I think almost every single person falls victim to one extent or another. So you have to be aware of these things. The cryptocurrency market is full of scammers. A blockchain analysis company found that in 2021, scammers collected $10 billion worth in crypto. The figure dropped in 2022 to 6.5 billion and in 2023 to 4.6 billion. But a significant amount of money is still being stolen. There are things like the pig butchering schemes, Ponzi schemes, phishing, extortion, rug pulls, giveaway scams, and charity scams. Crypto scams can happen through email messaging apps with predators pretending to act in your best interest. Wallets can be compromised by simply connecting the online wallet to an application and permitting it to access funds. While this is common practice for many crypto apps, scammers can use this technique to drain crypto wallets. To avoid these scams, never connect your online wallet to an untrusted application and keep most of your crypto funds in offline hardware wallets. Also, never give your wallet passwords, seed phrases, or private keys. Very important that you keep your seed phrases, private keys privately. Learn about the different types of scams, be aware of how they function, and never click promotional materials that you may happen to see inside your wallet. Even if you have a hardware wallet, they still connect to the blockchain, and occasionally you will see airdrops of things that are promotional materials, and those are highly likely scams. So be aware of what you're getting. Never think that things are given out for free. Nobody's giving out free things. Even airdrops are not free. Most cases, people are required to complete tasks in order to be eligible for airdrops. So nothing is for free. Just keep that in mind. Whenever you see something that is given to you for free or offered to you for free, always stop, question, and assume that it's a scam. When somebody contacts you and says that they're offering you a job with a reasonably priced pay, in most cases that's also a scam. Nobody contacts you out of the blue to offer you a job unless you know the people, you've talked to them before, and you're involved with them. And so make sure that you are aware of these scams, particularly things like the pig butchering scams, where people get sucked into establishing relationships with the scammers who drag a relationship out for a period of time before they actually begin attacking your wallet. So be careful. The 8th mistake that you need to avoid is trading on leverage. If you do progress in your trading game and you decide that you want to start trading a little bit more than just spot trading, spot buying crypto, and you want to try leverage, make sure that you understand leverage. It's a bit of a complicated game. There are different types of leverage trading, and you need to understand very well how those functions, because you could lose all of your money when trading on leverage. And once your funds are gone, once your funds are wiped out, you're out of the game. Basically, as long as you keep your funds in the crypto, even if crypto tanks, if you buy one Bitcoin and the Bitcoin goes from 100K to 50K, you still have one Bitcoin. That Bitcoin will go up in value and you will make your money back and make your profits back. But in leverage, once your assets are wiped out, they are gone. And it doesn't matter how much Bitcoin you had. Once your assets are wiped out, that Bitcoin is gone as well. So be very careful about leverage trading. Make sure that you understand how it's done, how it functions, and how it can affect your trading portfolio, because it's a very easy and sure way to lose all of your cash if you don't know what you're doing. And so that kind of leads into number 9, which is overcomplicated trading strategies. Don't make it too complicated for yourself. If you're not familiar with leverage trading, I would suggest to stay away from it completely. If you want to try your luck, then make sure to use it in small amounts. Don't bet your entire stash on leverage trading, because like I said, once you lose all of it, then all of it is gone. There are plenty of trading strategies being advertised on YouTube. Greed is a very, very powerful incentive for people to throw their money at something that may make them lose all of that money. Take some time to learn some basic technical analysis, conditional orders, and how the crypto market works. Takes time. I think every accomplished trader at any level will tell you that trading takes time. Learning to trade properly takes a long time, and most traders lose a lot of money initially when they start trading. So don't presume that you are any different, and by jumping into the trading market, then you have it figured out within a couple of days or a couple of weeks of trading or having some successful trades. You may have some successful trades, but you're most likely going to lose all of that if you're not very careful. So don't overcomplicate things. Understand some basic technical analysis, and study the charts first before you start jumping into some trading strategies that may be unfamiliar to you. Investing in crypto can actually be simple. There is no need to create a complicated trading strategy to try to and grow your portfolio like traditional investing. You can use the dollar cost averaging strategy without the need to actively trade and glue yourself to crypto charts 24 hours a day. And always keep in mind, buy low, sell high. That's the idea. If you're in profit, take the profit. Don't get greedy. Set goals and know what you're going for. Number 10 is order errors. While some crypto exchanges like Coinbase specialize in making it simple to purchase crypto, many have complicated order forms and trading platforms that confuse new users. When placing an order, a simple decimal point error could cost thousands, multiplying losses. For example, an error cost one seller nearly 300,000 when he sold a premium NFT for 0.75 ETH instead of 75 Ether. Huge discrepancy. To avoid these costly mistakes, always double check your orders or transfer before submitting them. When you place orders on exchanges, always make sure that you have the right numbers. Don't rush into buy or sell orders because that's the way to lose money. If you must rush, if you feel like you have to rush and you have to sell it now or buy it now, then maybe you should step away from the computer and just don't do it, because there is no point in rushing. Crypto is not going anywhere. And the last one, number 11, which is kind of a bonus, choose your currency wisely. There are thousands of cryptocurrencies, like literally over 10,000 right now, and most of them have been around for a very short period of time. A lot of them have been around for longer but have gone nowhere. I've been in the cryptocurrency space since 2017, and I've seen projects make promises, grandiose promises, and I've seen projects that looked extremely exciting on paper but then delivered virtually nothing, and they went into forgetfulness. They disappeared from existence. So if you are a new trader, your best bet is to look at the top 50, maybe top 100 projects, and decide which ones you think are best. Do your research, check out some videos online, see what people are saying, check out the project, see what the people within the projects are doing, the people that are working on the projects, and see if the projects that you want to invest are good projects to invest. And if worse comes to worse, just put your money into Bitcoin and play the long time game, because Bitcoin will go up over time. It will have fluctuations, ups and downs, of course, but over the long period of time, if you're not in a rush, which you shouldn't be in crypto or any investing really strategy, then you will make money. So those are my 11 trading mistakes to avoid in crypto. I hope those were helpful. If they were, leave me a comment in the comment section below. That would be fantastic. Also, please remember to smash the likes, because, you know, that always helps. That helps me tremendously. It lets YouTube know that people like it, and a lot of people watch the videos, they don't smash the likes. Just do it. Also, subscribe to the channel. Thank you for tuning in, and I hope to see you in the next video tomorrow. Have a good one. Peace.